People only think about taxes in April when it's really too late to change anything. But right now, while everyone else is checked out on summer vacation, the smartest financial minds are making two major moves to protect their wealth in 2026. And we're talking about mid-year bracket positioning and Roth conversions. Hi, my name's Sally Boyle, and I'm the founder of S.J. Boyle Wealth Planning, and I help individuals and families plan for a fabulous retirement. So first, you might be thinking that you're too young for a Roth conversion, but let's correct the single biggest myth in retirement planning right now. You can do a Roth conversion at absolutely any age. You can do it at 25, you can do it at 45, you can do it at 65. The IRS doesn't really care when you put money into a Roth. They only care if you try to pull it out too early. So today I'm going to give you an exact step-by-step blueprint to execute these mid-year tax moves before the summer ends, and why the One Big Beautiful Bill Act completely changed the strategy for 2026, and how to avoid the hidden tax tripwires that can catch most people off guard. So let's dive in. Why are we doing this right now? Because mid-year is the sweet spot. You finally have enough information, enough clarity on your 2026 income to accurately predict your tax bill. But you still have enough time to actually change the outcome. So step one is simple. It's find your taxable income. Grab your latest pay stub or your business revenue statement and add to it your investment income realizations, any realized gains, any dividends and interest. And that added together will estimate your total income for 2026. And then you subtract your standard deduction. It's 16.1 if you're single filer, and 32.2 if you're married filing jointly. And if you itemized deductions last year, just grab those off your tax return. Once you do that and subtract them, you can estimate where your taxable income is going to land. And if you look at this chart, you'll see exactly where you're going to land in your bracket. And thanks to the One Big Beautiful Bill Act, looking at these lower tax rates, they are permanent. So our strategy for 2026 isn't about rushing to beat some tax increase. It's really about bracket filling. Let's say you and your spouse are married and your estimated taxable income is $150,000. You are comfortably sitting in the 22% tax bracket. But also notice that the 22% tax bracket doesn't end until $211,400. So that means that you have $61,400 of bracket cushion. And you can realize an extra $61,400 income right now, and the IRS isn't going to bump you into the next tax bracket. So how do we use that cushion? Well, we fill it up by executing a mid-year Roth conversion. And this is where you move money from a traditional IRA or a 401k, where it's waiting to be taxed in retirement, and you move it into a Roth IRA where it'll grow and can be withdrawn completely tax-free forever. So if you do this before the summer ends, you beat the chaos or the frantic year-end rush to do this at major brokerage houses. Plus, if the stock market experiences a standard summer lull, which it does, you can convert your shares while the valuation is temporarily lower, which means you're moving these shares into your tax-free bucket for a cheaper tax cost. Now, let's talk about the age rules again, because the strategy does shift depending upon which side of 59 and a half you're on. So if you're under 59 and a half, remember a conversion is a long-term play, and the conversion itself is entirely penalty-free. However, a 5-year clock does start on every individual conversion that you make. So if you try to pull the money out or the converted cash out to spend it within those 5 years, the IRS will slap you with that 10% penalty. So if you're young, convert it, lock it in the vault, and let it compound. If you're over 59 and a half, those guardrails disappear. The 10% penalty is gone, and you could theoretically convert 40,000 this summer and withdraw that principal next year completely penalty free if you needed it. So it gives you the ultimate flexibility. But hold on, a Roth conversion is incredibly powerful, but it does have 3 major tripwires that will ruin your plan if you don't watch for them. And the first tripwire is, where do I pay my taxes from? Don't pay them from your IRA. When you convert money, you have to have cash sitting on the side in another account after tax money in a regular savings account or your brokerage account, and you pay the income taxes there that are due in April. If you tell your custodian to withhold the taxes from your conversion directly from your IRA, you are drastically reducing the compounding math. Even worse, if you are under 59 and a half, using IRA funds to pay the tax triggers that 10% penalty. So always pay the tax with outside cash. Tripwire 2, you can't cherry pick. If you have a mixture of pre-tax and after-tax dollars spread across traditional IRAs, the IRS forces you to convert a proportion of both pre-tax and after-tax dollars. So you can't just convert the tax-free part. And Tripwire 3 is the IRMA cliff for seniors. If you are on Medicare or within 2 years of it, a big Roth conversion spikes your adjusted gross income. And this could accidentally trigger these IRMA thresholds, which means your Medicare Part B and D premiums could skyrocket for a couple of years. So for 2026, that first threshold is $109,000 for singles and $218,000 for married couples. So mind that cliff. Mid-year tax planning is what separates people who successfully build generational wealth from people who just get frustrated in April. So what's your homework for this weekend? It's to pull your latest pay stub and look at your 2026 bracket. Calculate your cushion. And if you want a step-by-step guide on how to calculate the exact prorate tax liability, check out my video here. And then hit that subscribe button for more wealth building strategies, and I'll see you in the next video.